Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. I think if you watch Fast Money or the market call with any regularity, you will know that I'm not much of a smiler. Yet this morning, for some reason, I'm grinning ear to ear, baby. And that's because smack in the middle of our screen, Dan Nathan, is the great Elizabeth Young Thomas, back with us for the first time. I can barely contain myself, Dan.
Either can I, Liz. This is all you.
Oh gosh, I should have brought more material then. I've got to fill
you brought it yourself.
I'm so excited to be back. This was one of the highlights of my week. So don't mess it up, guys. Don't ruin it.
It's a high bar. But let me say this. I mean, it's bittersweet, I'm sure.
Can we throw a picture of the babe up, or this is Griffin? I mean, he's a beautiful baby.
Well, maybe later. I don't have one ready to go right now.
I had the one that I took when we were together.
Oh.
It was really pretty. You guys look great. All right, but by the way, this is like the most perfect baby. We've been getting pictures of it for the last few months or so. I got to hang out with Griffin. He's amazing.
I wasn't invited.
No, you weren't. You weren't, guy. All right, Liz, let's take a step back here because you guys.
Hold on a second. Let's forget about this steps back.
No, what
I mean, in some ways, your life is fundamentally changed. Let's just, before we get into the market stuff, like, is it everything you imagine? Have there been some curveballs along the way? I mean, it's a huge, you go from singlehood to wedded bliss to motherhood all in the course of a few months. And now here we are.
Yeah. I mean, my life changed fast over the course of a couple of years. Inevitably, there are curveballs at every turn, right? A baby in and of itself is a curveball. And I think the biggest thing you learn, anybody listening, and both of you who have had kids, you figure out very quickly that you cannot plan anything. You got to roll with it. You got to just let it be what it is. And whatever you expected it to turn out like is definitely not what it's going to turn out like. Sometimes it's better, sometimes it's worse, but the whole experience has been, I can't say it's been what I've expected, but it's certainly been exceptional, and it's been humbling, and it's been joyful. And I got to say, we got lucky because this is a good baby. This is like, he's a smiler. He sleeps pretty well. Yeah. He's a wonderful, wonderful little guy. So,
well, that's a function of the parents. And listen, I know I can speak for myself. Obviously, I've missed you a great deal. I can speak for Dan, but I also know the audience has missed you. So and I mean this since you know I am sincere. It's great to have you back, Elizabeth.
Thank you. It's great to be here. It really is.
That was a sincere smile from Guy Adami. It is great to have you back. It is a beautiful baby. I got to meet Griffin the other day. So, Liz, what's going on in the markets here?
I mean,
what's it like, like having one eye on it for what, 3.5 months, 4 months?
4.5 months.
Yeah. 4.5 months.
Wow. Definitely one eye. I mean, there were periods in there right around April 7th-ish when I had both eyes on it.
Yeah.
But then I took one eye off for a while. But I will say, and I talked about this on Halftime yesterday. If I would have gone to sleep like March 16th, woken up today, it's like, oh, we're at all-time highs, and all that really happened was there was this little rotation back into the mega caps, and here we are. But clearly, that's not all that happened. The other thing I will say, and I wrote about this in my note today, is that the forced slowdown and the forced step back from all of it, you don't realize how much you get so ingrained in the day-to-day and the minute-to-minute headlines and the data, and so obsessed with what's that going to do to this particular security. And at the end of the day, it doesn't really matter on a day-to-day basis. It matters on a longer term basis. It matters bigger picture. It matters what the trend is. But all of this like little, each click, each tick is just, it's exhausting. So it was nice to step back and come back with fresh eyes and just be able to look at things anew and say, okay, you know what? Everything that we thought was going to happen, everything that we thought made sense to happen, still hasn't. And it's tough.
You mean like economic slowdown, like a recession?
Well, even a recession, a huge blowout in bond spreads, right? A big pullback because valuations have been so high for so long. We've been talking about valuations being stretched for however long. I've got a great chart about that today, but it hasn't seemed to matter. So then you got to step back and say, okay, what's the other bull case? What's the other side of this? What's the part that seemingly every other investor is finding to be optimistic about. And can I get myself into even a little bit of that camp?
Yeah, but so let's just talk about this for a second, because this is, I never seen a market, or I've seen very few, where I think they're about is disconnected from what I believe the fundamentals to be. Like,
Yeah.
just here's like last night at midnight, okay, we just ratcheted up the trade war. And make no mistake about it, this is a trade war. The president has literally, you know what I mean, declared war on our allies from an economic standpoint, from our biggest adversaries, from folks like India, which we've spent 20 years cultivating, you know what I mean, as a like reliable, partner, that sort of thing. I think our companies see the 1,000,000,003 people in India as, not too different than they thought about China 20 years ago, as this kind of emerging sort of middle class and the like. And so we're just kind of tearing all that stuff up. And, it'll be really interesting to see. Trump is supposedly going to meet with Putin this week. Okay. It has to do primarily with Ukraine and the war and trying to get a ceasefire. But, Trump has also put those huge tariffs on India because they're buying oil from Russia. So it'll be interesting to see when Trump comes back from meeting with Putin. I guarantee it that he is going to be, kind of, I don't know. However, Trump comes back from meeting with Putin, going back for the last 10 years, that's the way he's going to be. I'm just telling you. And so it'll be really interesting to see, what is all of this stuff about? Is it about politics? Is it about policy? You know what I mean? Is it about reorienting global trade, that sort of thing? They've all kind of come mashed up together. And that's one of the hardest parts about it. So then you look at the stock market, and to your point, if you would just kind of, went to sleep for 4 months or whatever, here we are. But the economic situation is so much worse. Scott, is that fair to say, in your opinion, when you think about rising unemployment, if you think about the housing market, which is like really feels pretty stressed right now, inflation isn't going away, rates haven't really come down all too much. I mean, the list goes on. And I just, the market where it is, it just doesn't make a lot of sense to me.
Well, I mean, Elizabeth obviously can opine. I'll say this. I mean, the soft data had been sort of, I don't know, questionable for a while. Now some of the hard data is coming out, and it suggests that, maybe things are slowing down. And obviously people say, well, if that's the case, Guy, then that puts the Fed in place. And if the Fed's in place, that should put a floor in the market. And I get historically that's been the case. I'm not certain, though, that's the case this time, because there are other factors at work. And one of them is this resiliency of the inflation data. And if you just look at what came out the other day in terms of services on one side, things seemingly slowing down, but then the cost component of it is seemingly going up. And we've seen things like that a couple times since you've left, Liz. And, the market clearly doesn't care, but it reeks of this stagflation that we've been talking about, which for the Federal Reserve, there's no elegant way out of.
Right. So here's what I'll say. The biggest risk we know of is stagflation, and it continues to become more and more likely. It's not guaranteed, but it continues to become more and more likely. And one of the things that, if you look at just the inflation data from the most recent data, is the month over month core goods X autos. Okay. So core goods X autos up 0.6% month over month. That is a high reading. And what's happening to consumers is they're having to make a choice between spending more money on goods because they have to, because they're up in prices, and then they're pulling back on services. So that's what you're seeing in some of the hard data. The services data also now suffering because consumers have had to make choices between what they can spend their money on. But they're still spending money. And that's where people come up with the bull case of the consumer has held up. Everything is still going okay because the consumer hasn't stopped spending. Yes, the unemployment rate is rising, but we haven't seen this like huge blowout in layoffs. We haven't seen a contraction, right? We haven't seen a contractionary labor print. We saw big revisions downward. We saw a really disappointing jobs added number, but we didn't see a negative number yet. That's not to say it's not coming. It certainly can. And Guy and I will talk about escape velocity until our faces turn blue. Once it starts, it goes really, really quickly. But the reality is, we've thought it started. There have been maybe 3 false starts now. The first one being last August, when we had the big jump, the surprise unemployment rate jump. And now maybe this is another one. I think there was another one in between there. And it just hasn't reached that velocity yet. All of the metrics that should have told us that it was ready to reach that velocity, the SOM rule, all of these different moving averages compared to the most recent highs or lows, every single one of those has hit, and it hasn't happened yet. So I wouldn't say it's not going to happen. Of course, at some point it will. What will be the catalyst to that? Who knows? Could be tariffs. But the risk that we know, the biggest risk that we know that remains is stagflation. And it takes a while for tariffs to come through in the inflation numbers. So if all of these went on today, right, August 7th, so all of these except for China went on today, it takes 4 to 6 months for those to work their way into the inflation numbers. So we're looking at the end of the year before we can actually say, okay, see, tariffs were inflationary. So we've still got some time. So as investors, what do we do between now and the end of the year? We don't just sit on our hands in cash, right? So we have to find something to do with that money.
I typically don't ask two-part questions, and I'm not going to start now, but I will say this. As much as you were sort of on the periphery, 30,000 feet over the last few months, rightly so, there are a couple things that have happened that I'm sure captured your attention. And one of them was in early April. And it was not the stock market per se, but it was about 8 o'clock on some random Tuesday night when the bond market started melting down. And I guarantee that you either got phone calls or texts from people saying, what is going on? And for about a 4 or 5 hour period, there were some really strange machinations going on. And what I have said is the stock market's a bit of a sideshow for this administration. I think they're focused on it, but not laser. I think the bond market scared them that night, and I think they acted in kind on the ensuing day. Thoughts on not necessarily that evening, but was that sort of a tremor and we're waiting for the main event, or was that just sort of a one-off in your opinion?
So I believe that happened on my parents' anniversary. It was April 4th.
How would I know this?
But you wouldn't. I'm just saying it for their sake. But I agree. I do think the bond market scared the administration because it didn't do what they wanted it to do, right? It didn't react the way that they wanted it to. And it had an outsized reaction. So we've got interest costs that are a problem. We know this. We know that the administration wants the Fed to lower rates. When you've got a bond market that reacts in a way that they're not happy about, then you saw this quick rollback, right? Let's calm everything down. And then we had the rally that brought us to today. So to your question, do I think that's a tremor of something to come? The prevailing wisdom of traditional finance would tell you that the bond market is smarter than the stock market. The bond market knows things before the stock market knows them. If you look at what's happening right now, we've got a 2-year yield that is signaling that the Fed should be much, much lower than where they are, right? The divergence of it, I think it's about 70, 75 basis points, something like that, between the Fed funds rate and where the 2-year yield is. The bond market is going to win eventually, right? And that might mean that yields have to move to come closer to where the Fed funds rate is. But I do think that the bond market still matters very much, and the bond market will eventually win. So it's something that you have to watch. Now, Guy, you and I have talked about this ad nauseum, right? The spread between the 2s and the 10s is at 50 basis points, 50 something basis points positive. And it's been positive for a while. And I've said this so many times, it's not the inversion, it's the re-steepening. It doesn't happen on day one of the re-steepening, but this period is always really tricky for stocks to make it through, right? This isn't necessarily tricky for bonds to make it through, but it's tricky for stocks to make it through. So I think the moral of the story is the bond market will win. The bond market is very, very powerful. And if there's anything that's going to push a hand one way or another, it is going to be the bond market.
Yeah, but it's also worth noting with the 10-year at 4.22 right here, it's really where it was on March 1st. You know, when you think about that, right? And you can just take it back. It was where it was on October. And, you know, back in February, the Treasury Secretary of the White House, they were saying they were targeting the 10-year yield, right? And so, Guy, what you guys were just talking about, it was that volatility that we saw in that first week of April, right? That kind of spooked them to some degree. And you can make the argument that, okay, well, they've actually achieved part of that goal because they do have a 10-year that doesn't really have an upward bias right now. And especially when you just talk about what's going on with the 2-year, I know there's guys made the argument why, yields in the 10-year are not reflective of what the Fed funds or what's going on in the 2-year. And it might be more reflective of inflation and the like. I know our friend Doug Cass, he likes to call it slugflation, not stagflation. So sluggish growth, which I think is an interesting way to reflect that. Okay, so other than buying Palantir and Griffin's 529 in early April, which was genius. I mean, Guy, do you see that stroke of genius?
Oh, I mean, I've come to expect nothing less from Elizabeth.
Well, I think that purchase basically funded his college 18 years from now.
He's ready.
He's good. All right, let's talk. Well, one of the first things you come back and you start writing about is valuations. And so we've been talking a lot about valuations as we've gone through Q2 earnings season. We kind of highlighted some of the performance that we've seen of names, and that's when we'll say, okay, relative to itself or relative to its peers or relative to the market, that sort of thing. We track John Butters' work. Butters is telling us 22 times forward in the S&P 500 is much higher than the 10-year average of 18.5 times. So why is valuation one of the first things you want to focus on when you're back here?
Because it's something that we keep talking about as a problem and a reason to not buy stocks. And I'm not saying we as in us three. I mean, even just the industry at large. Everybody is spooked about valuations. Everybody uses that as a reason to not get into the rally, to not buy at these levels. And look, I'll be honest, I don't think anybody should aggressively be throwing money at this.
Right.
You shouldn't be entering. If you've had a bunch of cash sitting around, this is not the time to suddenly use all of it to buy at all-time highs. But when you look at valuations, I have a chart about this in the note if we're ready to bring that up.
Let's do it. Let's do it.
So basically, this is under a section called Bargains Be Gone. This is showing you percentiles. So valuations are always a relative game, right? You don't necessarily look at them as an absolute game. You have to look at them as a relative game. So even if you knew nothing about finance, you close your eyes and then open them back up and look at this in a blurry way. Obviously, all of these bars are very high. Okay. This is showing us valuations by sector compared to the sector itself. That's in the blue bars, and then valuations compared to the S&P in the magenta bars. So you can see the differences there. All of the blue bars are pretty high. So almost every sector compared to itself is expensive today. And the S&P itself is in the 94th percentile of its own valuation. That's pretty high. Okay. Can't go much higher than that. Many of the sectors, financials, industrials, are above 95%. So that's a big deal. However, if you're trying to find a way to put things to work, look at the magenta bars. What are the sectors that are actually trading okay compared to the broader index, right? So find the ones that have a magenta bar that's much lower than the blue bar. You've got things like financials, energy, some of the defensives, actually staples, although that is a beast in and of itself. Materials, healthcare. Healthcare's in the first percentile. It's like, when do you just start talking about that being so washed out that it's time to get interesting again? So we talk about valuations as it's too much. We can't do it. Nobody can stomach it. But having been away for 4.5 months, we were saying that before. We were saying that a year ago. We were saying that the whole way up. So then it's like, we couldn't stomach it when these percentiles were probably at, 75. And now they're at 95. And we're like, oh, we missed 20 percentage points in that move because we couldn't stomach it when they were lower than this. Now, I want to be very clear. I'm not saying that this makes sense, right? Nobody's going to look at this chart and say, oh, okay, I feel better, right? I feel like I'm getting a good price for all of these securities. Of course not. But this can go on for a long period of time. And that's, I think, maybe the frustrating part about it, because mathematically it doesn't make sense. Even emotionally, it doesn't make sense, but it can go on for a long period of time. You guys know this very well. Before the bust in the early 2000s, there were 5 straight years of 20+% returns. Okay. We've had 2 straight years so far. I'm not saying we're going to have 3 more, but it's happened before. And I bet there were a lot of people at that point saying, oh, we can't get comfortable. It's too expensive. It's too expensive, all the way up. So you look at something like this and say, okay, but how do I find some value somewhere in this chart?
Okay. Mario is no doubt listening. By the way, Elizabeth, as you probably have learned, we met Mario IRL. I think that means in real life at the last Fast Money Live event. Lovely young man. And we have been waxing poetic as the great work that he's been doing in your absence, number one. However, if I were Mario, which I am not, knowing full well you were coming back today, understanding how my mind works, I would have somehow implemented some songs from the band The Who. Are you familiar with The Who, Elizabeth?
I am familiar with The Who.
So I would have gone with something like, a few of their songs. For example, Bargain is one of their songs, so I would have had that in there somehow. Behind Blue Eyes is one of their songs. And of course, Won't Get Fooled Again. That's how my mind would have worked around this. So I'm just throwing that out to Mario for future reference. It's a little too late now. I get it.
Young man, guy.
There'll be another time.
You know what? I'll speak on his behalf. He will take your constructive criticism.
It's not criticism at all.
To do something. I guarantee you now next week, there's going to be like something.
Whoa.
Something's going to
Why
happen.
don't we send him? The Who is coming to MSG, I want to say, in a couple weeks or so. I think
you should send him. Maybe he'd learn something.
That. So maybe we'll take him there.
Liz,
All right, hold on. Let me just so yes, and now I got a serious point to make. Well, that was serious, but you mentioned how if you had adhered to that, it's 25-30% ago. In some individual names, probably 60-70% or so ago.
Right.
But that doesn't mean it's not equally ridiculous in terms of what's going on. And this is something we brought up. And you just said it. Everybody says it. We say it. These valuations are not timing indicators. But what they basically say is there's no valuation cushion in the market. And if you look at the performance of Berkshire Hathaway, specifically since April, it's completely underperforming the broader market. And I think it's because this $1 trillion company in the form of Berkshire Hathaway has $340 billion on their balance sheet. With each passing day, the market goes higher. What the market is saying is, you are not participating. We are going to punish you. But that Buffett indicator, which has stood the test of time, is now 3-4 standard deviations away from what he deems to be excessive. So I look at that, I look at your work and say, yeah, I mean, we would have been saying the same thing months ago, but it doesn't make it any more stark or any more concerning. So maybe just thoughts on that.
Yeah, I agree. And one of the things I would say too is that at these levels, so totally, we have to point this out to people all the time, not a good timing mechanism. You can't look at valuations and say, oh, this is a good time to get out, a good time to get in. From these levels, the market is really difficult to impress. Okay. And I think that's what we've experienced over the last few months. Everything's kind of gone sideways except for that handful of names. And to be fair, that handful of names had a lot of recovering to do after April. So even the ones that have gone absolutely parabolic, some of it was a recovery from a drawdown. So the rest of the market that has sort of just chopped along here, not gone down, but chopped along, it's difficult to impress investors at these levels. You got to have blowout earnings. You can't just meet earnings. You got to really exceed. And God forbid you miss, right? Punished terribly. And even sometimes the companies that have beat still punished a little bit. So difficult to impress. That means it's easy to disappoint. So you get one bad data point, like the jobs number last Friday, and there's this big pullback. So that's what investors have to be mindful of. And that's another reason, one of the points I made later in the column is about concentration risk. So yes, look at valuations as, all right, this is not the best time to be buying. This is certainly not a value investor's universe, but you still probably want to be present in the market. You still have to find a way to be present, because what if you miss another couple years? But at the same time, make sure that you're not over concentrating yourself. And I think there are still a lot of risks in that. People have passive ETFs that are index-based, passive ETFs that are momentum-based. Guarantee you that both of those have a lot of the same names in them.
Yeah, but listen, the index stuff, you take the top 10 names, they're nearly, 38-39% of the S&P 500. Fine. That's always somewhat the case here. And, we've seen a lot of multiple expansion in those big names. And, we've been tracking some of this. You've seen 60% or so of the gains. I think David Rosenberg had this stat a couple of weeks ago, this year is really multiple expansion. That's how you get to 23 times or whatever forward. And I just think that, at some point that concentration, maybe it's the story of generative AI, it just starts to digest a little bit. And I think that we're starting to see some dispersion in that. And just yesterday, for instance, AMD had this massive rally, 200% or so off its April lows. And the expectation is that they're ultimately going to have a chip that has better performance, the GPU, than Blackwell or Rubin or this and that, whatever. They're going to take market share. And there's so many of these hyperscalers that want to second source, and they're going to compete on price. And that's been the story for 3 years with AMD. Yesterday, the stock sells off 8% after a lackluster quarter. Lisa Su, the CEO there, keeps talking about this TAM, and maybe we can just do like a 1 week chart here. So the stock sells off, and then we have some bullshit announcement about, who's being carved out of these tariffs, these 100% chip tariffs or whatever. And now you get it all back and you fill in that gap. I mean, so that doesn't make a lot of sense to me. Last thing on valuation, let's definitely hit the concentration slide that you have, because I think it's really interesting. Doug Cass adds here, the equity risk premium. This is one of the last things I think we talked about before you left, okay, at 2.5 decade wides, okay? S&P div yield at 1.25% versus the 10-year yield at 4.2%. Doug saying rarely in history have you seen it this wide.
Yeah, 2002 is the last time it was this bad. So what does that tell you? In a very simple term, it tells you that you're not being compensated for the risk that you're taking in equities. And at these levels, you're taking more risk in equities than even normal times, because everything is at, again, that 90 something percentile. It can fall much further. And I've had charts, Mario certainly has this, we can bring it again maybe next week, charts showing basically as the index rises, what proportion of that rise is due to multiple expansion and what proportion of that rise is due to earnings growth. And the multiple expansion in our chart is kind of a pink color. The pink chunk is very large right now. And when you look back in history at some of the drawdowns, the only thing that disappears is the pink chunk, right? So what happens when you have a drawdown, especially a swift one due to some sort of sentiment shift, you lose the multiple expansion component very quickly. So that is the risk that investors are exposing themselves to. The concentration piece, and again, this is one of those slides that's going to tell you it's not different this time. There is always, in a lot of these market rises, there is always a small group of stocks that takes the market up this high. Sometimes it's 10, sometimes it's 15, sometimes it's a little bit more than that, but there is always a smaller group of stocks that drives the entire bus. And that's what we're experiencing now. This is showing you basically just the concentration, how pervasive it is. We thought it was bad a couple years ago, and now here we are, 40-ish% in the top 10 names. Everybody is overexposed to that, whether they like it or not, unless they're making some real active effort to get away from those names. And it's been difficult to do that, because if you try to get away from those names, you don't have any upside, right? So the tough part about this chart is, okay, here's an alarm bell, right? I mean, it's even colored red up at the levels. Here's an alarm bell. Everything's concentrated. We're still relying on the same few names. When's it going to turn around? At some point, it probably will, right? But again, you have to go back to, all right, but as a longer term theme, do I want to be invested in technology? I do. As a longer term theme, do I want to be invested in US technology or non-US technology? I want to be invested in US technology. If I were starting investing today, would I be investing all of my money at these levels? Absolutely not. But the reality of it is, for the next 5 to 10 years, I still want to be present in that theme. And if that's what's driving the market, so be it. Here we are.
In keeping with the theme of The Who, which is the theme of this show, you mentioned this bus. Of course, one of their songs would be Magic Bus. And it has been magical. But if we could quickly go back to the first slide, Jacob and or Stephen, you pointed out that the colors were, I think, some sort of blue and magenta, I think you said.
Magenta. I think that's
okay.
Magenta.
I believe so. Let's go to slide number 3, because for some reason we stayed with the blue, but we've gone to a purple hue now to talk about volatility. So talk to me about this.
I can't talk to you about the decision of the colors. We do have a certain set of colors that fall in our branding that we have to use. So we have a certain set that we have to choose from. I mean, I'm not sure why.
Palette, some might say.
in any event, Dan actually helped me with this chart.
Actually, did you hear that guy?
I
Dan,
wanted,
actually.
well, I didn't. Oh,
I'm just saying. I mean,
sensitive.
Well, how did Dan help you?
What I wanted to show was that I had a feeling that the market was expecting volatility to pick up, but that volatility itself had not been as bad of late. Okay. So it was like, how do I show that? We want implied volatility versus realized volatility. So I called Dan and I said, knowing that these things were based on options, I called my options guy and I said, how do I show this in an easy
Stop
way?
for 1 second there, and I want to hear you. Okay. So you had a question about volatility that are based on options. So you just said you have an options person in the form of Dan Nathan. Is there something out there that were to sort of cross your bow that would have you pick up the phone and call me? In other words, Guy is my X person. You don't have to answer that now. I want you to think about it. Please.
it's an easy one. Gold.
Well,
If you had questions on gold, you
I
talk
was
to Guy.
actually going to say the commodity complex writ large.
Okay. That's a good answer.
Broaden that out a little bit.
Yeah.
I like
Broaden
that.
it out. Anyway, back
And
to
then
you.
whatever your acronym is this year.
You want to know what my acronym is this year? Are you really interested or no?
I don't remember. I knew at some point. I don't remember.
Okay,
I know
so last year my acronym was CLAM.
Right.
This year it's TUBE.
Tube.
Yeah.
Is it spelled TUBE?
Yeah, but
tube.
But Guy will refer to his tube on the show.
Oh,
And he used to refer to his claim. We have no idea what any of that means, but that's just a fast money sort of thing. You're gonna have to tune in.
A few weeks ago, Joe Kernan guest hosted the show, and Joe's not prepared for some of the tomfoolery that goes on. And
I bet.
we were speaking to, I think, the EQT CEO, not us. Brian Sullivan was interviewing the EQT CEO. And when we came back from that interview, I did not allow Joe to speak. And I said, Joe, are you familiar with my tube? And he said, excuse me, which is the exact response I was hoping for. Anyway, sorry, Elizabeth. I'm sure you've missed this. So please, back to volatility.
Anyway, I would, and that's absolutely sincere. I would come to you about commodities and stocks related to commodities. So energy stocks, steel stocks, all that stuff. I mean, you guys are useful for other things too.
No, I was looking for more like an older brother type thing. Like I need, because you don't have an older brother, and
no, that's correct.
I would fit that category. But again, apologies.
We were talking about finance stuff.
I actually think you'd be more like the crazy uncle. Wouldn't it be as opposed to the older brother, the crazy uncle?
So somewhere in between.
Yeah. I think there's a lot of wisdom in
All right. So going back to volatility.
Anyway. I had a hunch that the market was expecting volatility to go up. So we wanted to show realized versus implied. I called Dan, what's the easiest way for me to show this that I can actually explain to other people? So this is what we're showing. So you can see, and I'll just do this very simply. Implied volatility is the lighter blue line. You can see this is based on 30-day options. You can see that implied volatility, there is a divergence between the two lines. So the market is expecting volatility to pick up. Now, truth be told, that probably happens right around every August, September period, because that's just what markets do. There's some seasonality to this. And there is some seasonality to all of the commentary that people are hearing because it's August and September. And because we have a little bit of a scar still from what happened last August, right around this time after a bad jobs number. So we have to keep that in mind. But we're looking at basically something that tells us investors are jumpy right now. And the other thing that Dan and I did when we talked about this was, okay, what's more expensive, a call option or a put option, right? On the market. And you're looking at put options being much more expensive than call options. So people are trying to protect on the downside, which makes perfect sense, especially with valuations where they are. So it makes perfect sense. People are expecting volatility and they're expecting that volatility to be down, not up. So looking at this again as an investor, knowing that you're concentrated probably in the top 10 names, knowing that valuations are at all-time highs, and knowing that the market is expecting volatility to come, a lot of times the expectation of volatility becomes a self-fulfilling prophecy, and people get jumpier when you get those little nuggets of news. Between now and the next Fed meeting, we have 6 big data points. We've got 2 more CPI reports, 2 more PPI reports. We've got jobs data. We've got a PCE report, and we've got Jackson Hole. Okay. There's a lot that is still to come because of this chart, because of the concentration, because of the amount of multiple expansion that's happened. You should expect outsized moves on almost every one of those data points, especially if they come in hot, because any data point that comes in hot between now and September 17th is going to look like that cut got erased, and the market wants a cut. I'm not saying that to say you should sell everything now and run away until September 17th. I'm saying that to prep people for probably a really dramatic couple months. And I think that's what we're heading into.
I think you just laid it out. I mean, all of those sorts of events, and Guy just kind of talked about hard data that's coming in. Obviously, it's the sort of stuff that makes the economy look weaker. And if we continue to see that, that's going to be the push and pull, right? What does a trade war do to inflation, right? And what does the trade war also do to growth? You know, I mean, like, it seems like at some point there's going to be the rubber hitting the road. And I think that's the thing that a lot of investors really don't know how to price, right? And so to your point about the 30-day at the money implied volatility, okay, that's the price of S&P 500 index options. You're generally going to see skew to the puts like you just highlighted, because there's just more demand for downside protection, right? And on the index level. But Guy and I have highlighted this, and probably while you were gone a little bit, when you saw like the Palantir and some of these other names, they were just a feeding frenzy. It was a retail frenzy. And when you see retail frenzy, you'll also see people reaching for calls, a lot of retail, right? Because that's how they can do it in a low cost, defined risk sort of manner. And then you get the skew to the calls. And when you start seeing calls more expensive to puts in individual names, you know things are getting a little bit euphoric. That's what we saw NVIDIA on numerous occasions in 23 and 24. The other thing I'll just say, and we'll put this in the show notes, you know, you can also look at the VIX term structure and the futures, right? And so let's just say we're at 17-ish right now. You'll see that kind of curving higher, which is generally what you will see. But if you look out to November, December, you're seeing VIX futures pricing about 21.5, 22 or something like that, which would imply, to your point, much greater moves intraday or on a daily basis than we're seeing right now. So again, I think the options market can be pretty useful. Also keeping a close eye on the CME Fed Watch tool, right? All that. So again, I think we surrounded the trade as far as valuation. What about just and Guy, do we have a couple questions you want to hit?
As I mentioned at the top of the show, how much I missed you. I said I can only speak for myself, but I know Dan feels the same way. Then I went on to say that the audience also feels that way. And of course, you got accustomed to many of these folks. Maybe you've forgotten some of the names, but the great Wavy McFly joins us yet once again. And he has a question in the form of what's been going on in Japan. And I will tell you, Elizabeth, because I'm sure at some point you've read about this. They have a real problem over there. And again, people say, Guy, you're making a big deal out of nothing. And maybe I am. But it was this time last year where the yen carry trade sort of blew up. And right before our eyes, 10-year JGBs are at levels we haven't seen, I think, in 13 or 14 years. 30-year, 40-year rates in Japan are at all-time highs. Their currency continues to sort of try to figure things out. I mean, they're up against it. And it's not having any impact here whatsoever, but Wavy clearly is watching it as well. So thoughts on that?
You know, this is another one of those forces. And I remember, Guy, last August when this happened, we were like, oh, here it is. We've been waiting for this. This is what's going to do it. And it did it for 3 days, and then it was over. So, the currency piece, and I know we've explained this before to people, but for the longest time, the Japanese currency was very, very weak. Not to say it still isn't weak, but it was very, very weak. So the carry trade had a lot of assets in it. So you borrow in that weak currency and then you invest in a stronger one. A lot of that was between the Japanese yen and the US dollar. So as the Japanese yen started to strengthen, people got really freaked out. And it was like all of this leverage that was out there in yen suddenly was going to become a lot more expensive. People were going to get margin calls, all of these things that would have catapulted it into a really bad situation. And that certainly did happen for a little while last year, but then everybody repositioned because they were worried about it happening again. So the risk of it went down after the scare last August. It still exists, but it went down. Now, anytime you have a major bond market, I think there was a day, it might have been a few days while I was out when the JGBs had like 20 basis point days. And we had seen that in treasuries. Unfortunately, as investors, we're accustomed to that now. We're almost desensitized to a 20 basis point day in treasuries. We had one on Friday, I think, almost in the 2-year, including the aftermarket. It was 27 bips or something. And now we just sort of look at that like, oh, it was a big day. In Japan, that is a huge day, right? Because their bonds haven't moved in decades, and they had their rates fixed at 0 for such a long time. And then they had a cap, but they had the 10-year cap to 10 basis points for a long time. So the moves that they're seeing now, not only does their market have to figure out how to digest that because it hasn't happened forever, but it does have ripple effects around the world. To your point, though, it hasn't caused any yet here. Now, that doesn't mean it won't. And at some point, maybe we look back after some sort of big global event and say, oh, you know what? The yen is actually what sparked that whole thing. We'll see. I mean, it's definitely, Wavy, I'll say this, definitely something to watch. Okay. But is it what's going to take all of this down the way that we thought it would before? I don't think so.
Okay. Dan's got to, let me just say one, I apologize, by the way. I don't really apologize.
Oh, it's your show.
We brought the Who in. We invoked the great band, the Who, one of the top 5 bands of all time. Of course, the lead guitarist of the Who, as you know, Elizabeth, and Wavy does as well, is great Pete Townsend. Pete Townsend had some solo work that he did. Empty Glass, great album. But he also had an album, All the Best Cowboys Have Chinese Eyes. That's the actual title of the album. So please do not cast aspersions my way. But one of the songs on that album is Slit Skirts. And the line from one of the lines from that song that resonates with me, and I think this is what I struggle with, and I want you to listen to this carefully, everybody. No one respects the flame quite like the fool who's badly burned. Now, if you think about that, we have ultimate respect for what we deem to be the flame because we've been smoked by it before. So that's why we have such respect for it. But yeah, there are other people that have not experienced that. So they're a little more willy-nilly. Dan, you see what I did there, Dan Nathan? You like that?
No, you lost me. What album was
How did I lose you? That's genius. No one respects the flame quite like the fool who's badly burned. So if you've been burned by it before, you have the utmost respect for it. It's like, oh, I've seen it. I'm not getting anywhere near this shit. Back to you.
But isn't there a lyric from Blinded by the Light by Bruce Springsteen? Mama always told me never fly. What was it? I got to get this. We'll get this. But,
that's why you wouldn't have been a great lawyer because in that profession,
I'm just riffing here, man. Okay, because
you have to know the answer before you ask the question.
Right. Well, last night on Fast Money, Melissa said there's winners and there's losers. And what did I whispered to you, and don't get caught on the wrong side of the line. And that's from Atlantic City, Bruce Springsteen, Nebraska, I think 1981. Does that make some sense here, Guy? I don't know.
Nebraska was not one of my favorite Bruce LPs. It was just a bunch of rambling. It would have been better as sort of a poetry book, but as a musical interlude, it did nothing for me.
But like he just toned it down. He had a killer 70s, and to come into the 80s a little bit, he wanted to do an all acoustic sort of thing. It was definitely without the E Street Band. It was a little melancholy. He did it again with Ghost of Tom Joad. I think that was in 1995. He's had some other instances where he's done that. He's actually earned that right after the 70s rip that he had. You know, if you think of
Bruce Springsteen, he can do whatever he wants.
Born to Run.
He can start playing the banjo like Steve Martin. I mean, he can do whatever he wants at this point.
Yeah.
See, when Dan says like that, Elizabeth, that's typically when I've completely lost them.
Mom always told me not to look into the eyes of the sun, but Mama, that's where the fun is.
Well, if you recall, President Trump in his first administration, there was what do they call those things where the sun gets blocked?
Eclipse, which is actually one of my favorite Pink Floyd songs, Eclipse.
Sure.
Great.
Eclipse, by the way, is a great name for an offensive lineman. If you nickname you Eclipse, it means you're a very large human being that eclipses everything else. No, but quickly, they told everybody, they put out public service announcements. Your friggin' iPhone blew up at you. Do not look up.
I mean, look, Mama, the sun. because that's where
By
the
the way,
fun is.
in
'Cause
case
that's where the
anybody,
fun
in
is.
case anybody thinks we rehearsed this,
By the
it
way,
was
and
crystal
if you
clear that
think
we did
that,
not.
also if you think that we like, Photoshop that,
No,
we,
that's actual.
yeah.
The man. Look, I mean,
Sorry.
Do you
everybody
hate
said
this? So, like earlier, guy, she just said something like, "I got a feeling," and I immediately went to the Beatles. I got a feeling, right?
Yes.
Did you?
I
Were
went to
you
the Black
thinking
Eyed
about that?
Peas.
She went to that other shitty
That's
song
really
by
interesting.
that Fergie person. That song is god awful.
I don't like the song, but that's what
I saw them open for U2 in Las Vegas. I want to say in 2009 or 10.
I mean,
they
I think
suck.
we all come from a slightly different music generation.
Yes, that's fair.
All right. So Doug just sent this. Okay. So this is Blinded by the Light, which Manfred Mann made popular, but it is
Sure,
Bruce
Manfred Mann's Earth Band.
Okay, but it is Bruce Springsteen's song.
That you wrote it.
Older on my shoulder, feeling kind of older. I tripped the merry-go-round with the very unpleasing sneezing and wheezing. The calliope crashed to the ground. Now, a lot of folks did not like this sort of sing-songy sort of bit by Bruce.
Grimy.
It was early
rhymy,
rap
a
stuff,
little
if you
this.
think about it.
It kind of was in a way, and I was there for all of it. Okay. And so the other point I just wanted to make is like after Nebraska came Born in the USA. And Born in the USA made Bruce Springsteen the biggest rock star on the planet.
Yeah.
Which,
really-
oddly enough, is one of my least favorite. Very
Oh, there's some great
commercially.
stuff on there. Darlington County and
Ugh.
Working on the Highway and I'm on Fire and My Hometown. Dancing in the Dark, that was horrible.
Awful.
I mean, that was one of the worst songs.
Awful.
But Glory Days is kind
Awful.
of
Glory Days is a shitty song.
when I hear Glory Days, I think of Guy Adami. I don't know why. Because
I
by
don't
the
know
way,
why you.
at Fast Money
I
Live-
never
Oh,
bring.
can
I never bring.
hold on a
stuff
second.
up.
At Fast
When
Money
do I
Live,
bring
we
anything
had a
up?
panel, okay, and it was Q&A, and somebody had read Guy Adami's Wikipedia page, and he read that from Croton on the Hudson, circa like 1982, Guy Adami had a pick six, and it wasn't just a pick six, like he was waiting around, you know what I mean, in the red zone a little bit, or that's 105 yards. And Guy, if you're sitting around telling that story at your like 50th high school reunion, you know what's playing in the background? Glory Days.
Yeah, but I'm not sitting around telling that story. I don't. No.
Hey, Jacob,
I live in the here and now.
Can we get eyes on Guy's Wikipedia page?
I held on a second. I might have a picture. I'm sorry to
Can you
do
go in
this.
and edit it? Can you go in and even make
And
it
then
more
can we
grandiose?
get
No,
Glory
there are like articles written about it, but
We
there's
just
a
need
good.
we need a little soundtrack. The soundtrack of Guy's life is Glory Days.
Yeah,
Glory
it's
Days.
not. Hold on a second.
Oh,
Before
are
we
you
get out
getting
of here.
pissed? Are you getting a little? Oh, there it is.
Look at that.
What year was it, Jacob? I can't really see that.
The
That was
New York
probably
Times
1981, if I had to guess.
Guy was also an Ironman, like not
Yeah.
doing a sprint,
I
doing
think you're
an
always,
Ironman.
You're always an Ironman, so it's not was,
Aw.
is.
Oh yeah, once you do it,
Yeah.
You have fuck you ability the rest of your life, apparently.
yeah, you do.
According
Look,
to-
there it is.
I'm gonna send Jacob a picture.
Yeah, but
Okay,
where
so
is it in here? Because
Hold on a second. Jacob, you want to put this up? This is me. I remember exactly where this picture was. So put this picture up, Jacob, real quick. This was
Guy, you raised $681,730
much true.
for that's amazing. Honestly,
That
for the
is
New
amazing.
Jersey
That's the only reason I
chapter of
finished.
leukemia and lymphoma, and just a real quick story there. Guy was on the board, and they're sitting around talking about creating a team for the first ever New York Ironman.
Uh-huh.
And they're getting some people either, yeah, this guy would be great, that guy would be great. And all of a sudden somebody says to Guy, hey, why don't you do it?
Why
You
don't
know?
you do it,
He's like,
bitch?
Yeah. Is that all you needed? Like just somebody to
Well,
like,
I thought about it, and it dawned on me that the stars were aligning, and there was a reason why that I had the previous night met the three guys who were going to put on the first New York City Ironman, and there's a reason why at the board meeting Ironman came up. So I said, you know what? The stars are aligning. I'm going to give this a shot, and
a lot of
never in my
pressure.
wildest dreams.
Raise
By
all
the
that
way,
money.
Fatal 9998. Throw this up. This is very good.
What do we got? Do we have the picture?
Oh, I
here?
don't know. I mean, Jacob should have access to this.
Liz, aren't you glad you came back
Guy
for
is
this?
Al Bundy. So you see this picture?
Holy-
Oh boy.
All right. So this, I know exactly where this is halftime. This is at Valhalla. So our white uniforms were our road uniforms. And I'm looking around. I'm like, you motherfuckers and this is not the other team. These are my teammates, because we were getting our ass kicked. You could see, like, I'm all,
yeah,
I'm just pissed off. That is a classic Guy Adami face.
All right, Guy, were you 82 or 32?
82.
Okay.
82. Good year.
82.
Mm-hmm.
Yeah. But you've seen that face before, by the way.
Who's your favorite number 82 football player? So it's obviously
I don't have an answer to that. I was a tight end, wide receiver, and I played like a monster.
Fast? I look at you and I don't say fast. I don't.
You'd be surprised, actually. I had wheels at one point. Yeah.
Really? And what'd you play on defense?
It was like a free safety. They let me sort of roam around and do my thing. Like it was
returns, anything like that? Anything?
What's that?
Kick returns? We punt?
No, but I didn't come off the. I was one of the. I didn't come off the. I played all the special teams. I just didn't come off the field.
Did you get how many penalties?
I actually held. I was the holder for point afters and field goals. Believe it or not.
So you had good hands too. I wouldn't have said good hands. Would you?
My great hands. No, can I tell you something? To this fucking day.
By the way, Guy, while we're on football, Liz, what did I bring your young little child?
Oh my gosh, my little guy now has Packer clothes, more Packer clothes.
Really? So that wasn't original. I brought some Packer onesies for the guy.
So, no, that's a nice gift, but
not some Packer one. It's like he's got one for this season, and Dan thought ahead and bought one for next season. So
and the little hat,
and a hat,
because he's going to grow.
Right,
Guy. I got to tell you, this kid is so cute. We went to a restaurant. It was quiet, and this kid didn't make a peep until he kind of crapped himself and puked all over himself. And
restaurants,
but he is a beautiful baby, and he liked me. He smiled a lot at me. He was grabbing my hand a little bit. Yeah. He was really cute.
Yeah.
Liz is back. It's great to have you back. We really
did. You miss this level of just?
I did. It'll
take you a while.
People like this. I have no idea. God, do you have any idea? People like this stuff, and they're probably going to.
I love it. I could do this for hours, but you know this.
Yeah.
My mind is really. I just told Bill Hockman it really works in odd ways. Like it's like a word association thing.
So let's just do this really quickly before we get out of here. All right, Liz, taking some stock of the market. We just talked about you have a VIX at 17, you have an S&P 500 still at 6330, and what was the high? 6400-ish or something like that, or a little above that. You have a 10-year at 422. Your Russell 2000 can't get out of its own way. It's still down. And we have, the Bitcoin is still hanging in here. You still own your Bitcoin? You're still in the Bitcoin or no? Like
we don't offer it on SoFi yet.
Yeah.
So
okay, it's coming back.
When we had it, I owned it.
Yeah. Okay. Just in general, Guy, we're coming out of Q2 earnings. We have retail coming up. Yesterday was a weird day, Liz. I don't know if you saw Walmart broke out. You saw some state. So I don't know. It'll be interesting to see what the read is, because a lot of the banks said that the consumer's just fine, and that was about a month ago, or it was about 3.5 weeks ago when we heard that. So
let me tell you something. The consumer is not fine, and the next time Liz is back, we will get in. Maybe Mario wants to get a head start on some of these delinquency rates and really what's going on below the surface, because the speed with which things have been deteriorating, we haven't seen in quite some time. But that's for another show. And before we get out of here, I'll say this on a serious note as well. Obviously, I love seeing you again. But in terms of the market, those reversals we saw last week, we hadn't seen in individual names in broader market. And although earlier this week and at times this week, it felt like that sort of was in the rearview mirror, there are still a lot of weird price action going on, Dan. And today, once again, is sort of indication as to exactly that. So I just say, as we get into August, I think you're looking at a VIX with a 17 handle. I'll go on record as saying by the end of the month, I think you're going to see it at some point north of 25. So stay tuned.
Whoa. The other thing is,
I think that's fair though.
So let's just mention this really quickly. Yesterday, Apple was up 5% on this announcement that they're going to spend an additional $100 billion here in the U.S. That's kind of bullshit. We were talking about yesterday that they're spending $4 billion a year on CapEx. We highlighted that. So then it's up another 3% today. All right. So a little housekeeping. Liz is going to be joining us, Risk Reversal podcast, every week. It's going to drop Tuesday mornings. So go follow it in your favorite podcast store. Liz is also going to be kicking up again her own podcast. It is called The Important Part. Go find that in your favorite podcast.
We have that. Hold on a second. We didn't do this.
Do it until
Can we put the slide up?
Okay.
Can I read the slide?
Go follow it.
Yeah, go ahead, guys.
Sign up today SoFi.com/on-the-money. Or Dan,
or just go to the SoFi blog, which
Just go
just
to
go
the
to the
website.
SoFi
Go to
blog.
my
Did
Twitter
you miss that?
account.
By the way,
Go
we
to-
had so much fun with
We had
that
so
over
much
the
fun with
last
that.
months.
I
It's
just
so
can only
good.
imagine.
Liz, great having
look at her. Look at it's amazing. The exuberance she had 54 minutes ago is turned into complete, like, oh my God, get me away from these maniacs.
A little exasperated there, I think. You know what I mean?
I
So,
love you guys.
all right. Great to have you back.
Great
Liz.
to be
All
here.
right. Thanks.
Yeah.
Thanks, everyone. See you tomorrow.